Hi everyone, welcome to today's session. So this session, Wei Mei and myself are going to introduce to you the newly launched Endowus Low Volatility Fixed Income Portfolio. My name is Yuling and I am the investment lead at Endowus. Joining today is also Wei Mei, who is the Chief Advisory Officer at Endowus. So Wei Mei is going to take us through an overview of the portfolio first.
Thank you, Yulin. So first of all, we have put together the low volatility fixed income portfolio because we have got investors who are looking to gain exposure to fixed income, but they want something that is effectively more defensive, lower in volatility, and therefore we have put together this selection which will comprise of a shorter duration selection of fixed income funds with average investment grade credit quality. It will be globally diversified as well as having a broad range of sectors. We have decided that the use of unconstrained, total return and short duration fixed income funds will suit the profile of this portfolio the best. And we do anticipate that it will have a strong return potential because we will be allocating more than 60% to corporate bonds. And currently, as the economy improves, it is likely that corporate bonds will benefit from improving fundamentals and also at the same time tighter credit spreads. So now what you see here would be our choice of 6 best-in-class funds. They are managed by renowned fund managers, namely Brandywine Global Investment Management, Dimensional Fund Advisors, Fullerton Fund Management, Lion Global Investors, PIMCO, and UBS Global Asset Management. This portfolio has been constructed by balancing key considerations such as diversification, downside protection, and also the overall total return potential that we can achieve to help you reach a desired investment outcome. So 3 of the funds that you see here are short duration, and therefore in a rising interest rate environment, we do believe that they will certainly have a lower volatility. The other 2 funds are managed with an unconstrained style, and therefore they are able to dynamically allocate to different sectors depending on where we are in both the market as well as interest rate cycle. So this will certainly help the managers to enhance return because they don't have fixed constraints, they are not benchmark oriented. And finally, we have a total return fund that has been included to anchor the portfolio to provide a stable sector and also credit allocation. So in combination, I think the 6 funds are going to be very helpful for investors as they think about continuing to use fixed income as an effective diversifier in their overall strategic asset allocation. So now, I'll invite Yulin to share with you why is it important to still have exposure to fixed income. And this is not the time to avoid fixed income altogether, but to think about a better way of allocating to this asset class.
Thanks, Wei Mei, for the introduction. So before we touch on the low volatility aspect of the portfolio, I think it will be very helpful to briefly touch upon why fixed income should be part of an investor's allocation. Firstly, actually allocating to fixed income can help investors to build a more balanced and diversified portfolio. So this is illustrated with the table that you can see. And basically the table shows you the return and risk as well as return over risk ratio of 100% equity, 100% fixed income, a 20 and 80% allocation to fixed income and equities respectively, and a 40 and 60% split between fixed income and equities. So if you look at the third row, you can see that actually by allocating 20% to fixed income, you can reduce the total volatility of your portfolio by 20% compared to a 100% equity portfolio. And if we look at the risk-adjusted ratio, which is a very important indicator because you want to get as much as possible with the risk that you take. And by allocating 20% to fixed income, you can actually improve this outcome by about 12% based on the simulation that we have done using data from 2003 up until the latest month. So this is actually diversification case in point, because traditionally fixed income and equities, they do have a relatively low correlation. So by combining the two lowly correlated asset classes together, you will be able to achieve a better portfolio outcome. Now, a second point, which is kind of related to the first point as well, is that allocating to fixed income helps to provide downside protection during market volatility. So what does that mean? If you look at the chart, it actually shows you from the global financial crisis, the 6 worst equity market drawdown that has happened. And the equity market's drawdown has ranged from negative 8.5% in Q1 2018 to a shocking 52% during the global financial crisis. Whereas in contrast, the global fixed income markets, which are represented by the darker blue line and the black line, so darker blue line is just a global aggregate index, and the black line is a pure credit index. Both of them have actually fared really defensively and resiliently during the worst performing periods of the global equity markets. So it is a very important thing for investors to be able to stick to your investment strategies. But psychologically, we are all tempted to panic sell during market drawdowns. So allocation to fixed income provides this kind of protection when it is most needed, ensuring that investors can stick to the long-term investment strategy and don't get spooked by the sudden losses in the markets. Now, finally, we do understand that some investors might be concerned with the impending uncertainty due to the upcoming rate hikes, and in particular, there might be heightened volatility with the beginning of Fed tapering. While this is a valid concern, instead of shying away from fixed income completely, investors can actually consider, firstly, shortening the duration of fixed income portfolio, as well as, secondly, increasing allocation to corporate bonds. So the former offers potential defense in a rising rate environment, and the latter can potentially preserve the total return prospect, as corporate bonds, they do pay higher coupons than government bonds, and in addition, corporate bonds, they can potentially benefit from the recovering economy due to improving corporate fundamentals, resulting in tighter credit spreads. And the chart illustrates how such a combination of short duration and corporate bonds has worked in the past episodes of rate increases. So the black bar shows the performance of short duration credit during the past episodes of rate increases, and the dark blue bar represents the global investment grade credit market, and the light blue bar represents the global treasury market. So generally, we can see that short duration credit have realized less than 1% loss during those periods, or at times even positive returns, while longer duration credit and the treasury, they were hit much harder by the rising rates. Now let's briefly discuss who should invest in fixed income markets. As explained before, it is generally desirable for investors with a lower risk profile to have some allocation to fixed income investments. However, this doesn't mean that fixed income is entirely safe. It still has volatility and drawdown, and depending on the specific allocations, the level of volatility varies. And the chart visualizes this for us. As we can see that during the global financial crisis, the global credit market, which is represented by the lighter blue line, suffered a maximum drawdown of negative 11.3%, while the shorter duration credit market has only experienced a negative 4.2% maximum drawdown. But the flip side is that we see a clear relationship between the level of volatility and the long-term growth of wealth. It is therefore really important for investors to be cognizant of one's own risk tolerance and return objective when deciding upon fixed income allocation. Now, I will hand over the time to Wei Mei to discuss more about why you should consider Endowus low volatility fixed income.
Thank you, Yulin. So we have put together this low volatility fixed income portfolio for our investors with a conscious view that we are now in a rising interest rate environment, and therefore it will be important to focus on what would be the most ideal duration level for the portfolio. We have therefore intentionally limited the duration to be around 4 years because that's where you would be at the belly of the curve. You will be able to get rolled down because of the steepness of the yield curve, but at the same time, there is also going to be sufficient yield pickup compared to being at the front end. The other consideration would be making sure that our sector allocation is predominantly focused on corporates because corporate bonds at this juncture are providing also decent yield pickup, and that's where improving corporate fundamentals will help this portfolio continue to have good total return potential. If you look at volatility by design, this portfolio is going to sit in between our Endowus 100% fixed income flagship portfolio as well as the CashSmart Ultra portfolio. So versus the 100% fixed income flagship portfolio, it will be lower in terms of volatility as well as drawdown. But versus that of CashSmart Ultra, it will have a higher yield to maturity. So that's how we would be calibrating it. And I think it's an important consideration for you as you think about where do you want to allocate to in terms of fixed income in a rising interest rate environment. So now moving on, let's just take a look at how the portfolio would work when we are looking at active managers. Because one of the key things here would be how to navigate the rising interest rate environment, and are you going to be better off with active managers compared to passive index fund? And what we are seeing here is that historically, active managers have been able to outperform. And we do think that with this portfolio, you are going to be rewarded for the amount of risk that you take. So while you're not going to get as much of a total return compared to being longer duration or going with a 100% flagship fixed income portfolio that we have, but you are going to have very good risk versus return numbers. And underlying funds are going to be active and dynamic in nature. And as a result of that, we believe that the managers themselves can achieve superior risk-adjusted returns, and they can also harvest different alpha opportunities in the broader fixed income universe that we have. And for us, when it comes to portfolio construction, we are combining lowly correlated active funds. Therefore, the result is further improved. And with that in mind, I think this is a portfolio that you should certainly consider. Finally, I want to touch on our fund selection process. It is both qualitative and quantitative in nature. We also run a proprietary scorecard where we are able to rate the funds that we select during the due diligence process. Suitability is something that we consider a lot, and we looked at it in terms of a range of different risk factors. So every fund has got a product risk rating, and in combination, when we put them in a portfolio, we run an optimization to understand the correlation across the different funds. We also balance other aspects such as yield to maturity and duration and their respective trade-offs. So it's looked at in combination, and it is a holistic way of making sure that the portfolio is going to work best in the environment that we are envisaging going forward. We do monitor the portfolio on an ongoing basis, so funds may be added or replaced to improve the overall risk-return profile. So investors like yourself should feel reassured that we maintain a continuous oversight on the portfolio, and we are making sure that it is well taken care of. So now I'm going to hand the time back to Yulin, who will talk to you about the details of the portfolio with this deep dive. Over to you, Yulin.
Thank you, Wei Mei. Let's take a look at this table first. So this table has the detailed allocation to each fund as well as the total expense ratio relevant for each of the funds as well as for the entire portfolio. So for all 6 funds, we either use the institutional share class with no rebate, which is the case for PIMCO, or retail share classes with 100% trailer fee rebated back to our clients, so that we can help you to achieve the lowest cost possible for you. And in terms of the allocation, just to break it down with a bit more details and colors, you can see that about 68% are allocated to 2 unconstrained bond funds from Legg Mason UBS and to 1 total return bond fund from PIMCO. So just an explanation that Brandywine is actually a subsidiary under Legg Mason, which is acquired by Franklin Templeton. And the remaining 32% are allocated to short duration bond funds from Dimensional, Fullerton, and Lion Global. So finally, this slide compares the longer-term portfolio risk and return to other Endowus portfolios as well as the 2 Bloomberg credit market benchmarks. So note that the underlying funds were incepted around different times, and prior to the fund's inception, we populated the representative historical data that is consistent with our methodology in order to show investors a longer-term view of the asset allocation's risk and return. So comparing the longer-term result and outcome of the portfolio with other Endowus portfolios, as you can see that its risk does fall somewhere between the Endowus 100% fixed income flagship portfolio and the Endowus Cash Smart Ultra portfolio. So does its return. And looking at the benchmarks, so there are 2 benchmarks that we're showing. The Bloomberg Global Aggregate Credit Index, which has a longer duration than our portfolio, and it represents the broad global credit market. And there is another Bloomberg benchmark, which is the 1 to 5 years index, and that one has a shorter duration than our portfolio. So very consistently, our portfolio's risk and return also falls in between these 2 benchmarks, which is pretty much in line with our expectation. Great, so that is the end of this presentation. Hope it has been helpful and informative to you. And if you want to learn more about the portfolio, please check out our Insights article online.